Apex entrepreneurs, and welcome. The second indicator we'll be discussing in this video, the PEG ratio, and is equal to the price-earnings ratio of a stock over the growth rate of its earnings for a specified period of time. So we already know how to calculate the PE ratio. And for the growth rate, we usually consider the average growth per year over the last 5 years. Let's return to Facebook for an example and calculate the PEG ratio. So, as we learned earlier in the video, the PE ratio is equal to $33.96, or 33.96. And looking at Facebook's average annual growth per share over the last 5 years, it's around 48.3%. So the PEG ratio is equal to 33.96 divided by 48.3, which equals 0.71. When we look a bit closer at the formula of the PEG ratio, we can see that the earning growth is in the denominator. So, the more a company is growing, the bigger the denominator, and the lower the PEG ratio is. In simple terms, this means that the lower the PEG ratio is, the better it is. As a rule of thumb, when a company's PEG exceeds 1, it's considered overvalued, while a stock with a PEG of less than 1 is considered undervalued. We should note here that in the last couple of years, we've still been in a bull market, meaning the majority of stocks are actually overvalued. So it's really difficult to find a company like Facebook with a PEG ratio less than 1. In a bull market, it's difficult to find value. But in a bear market, you can find a lot of undervalued companies to buy. First, the price-earnings ratio, or PE ratio, relates to a company's share price to its earnings per share. A high PE ratio could mean that a company's stock is overvalued, or that investors are expecting high growth rates in the future. Companies that have no earnings or that are losing money do not have a PE ratio, since there is nothing to put in the denominator. The PEG ratio enhances the PE ratio by adding in expected earnings growth into the calculation. The PEG ratio is considered to be an indicator of a stock's true value. And similar to the PE ratio, a lower PEG may indicate that a stock is undervalued. So in our evaluation so far, we've taken into account the price of a share, the earnings per share, and the growth of the earnings per year. But this isn't enough. We still have to take into account many other parameters, such as equity, debt, and many others.